Welcome, everyone, to this legal office hours. Today's topic, overcoming common deal sticking points. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsors. Attorneys James David Williams and Bill Barlow are going to host our session today. James David and Bill are partners in Barlow and Williams, a practice that specializes in small business M&A. They are at the front lines of the market. Their focus is helping searchers, sponsors like you all get your deals done safely and to your benefit. They also, in other transactions, represent sellers, so they see both sides of transactions in this market. This is their 14th office hours with us here at Acquiring Minds. Thank you, guys. The way we run these is that Bill and James David will do their presentation, and then we'll do Q&A. To ask a question, use the Q&A function of Zoom. We have chat turned off, so use that Q&A function. If you have a very detailed question, we may or may not get to it live, but ask it anyway, and James David will file it away and do his best to get back to you later after the webinar. He does that very successfully still, right, James David?
Yep, although we may be a little bit of a lag this time because I'm going on vacation tonight. So
you're not going to answer people's questions from vacation? Slacker.
Probably not. No.
And of course, as always, you audience will get the recording by email, and the deck will send an email with a link to both of those, deck and recording, in the next 24 or so hours. James David, Bill, please, over to you. Oh, sorry, wait, no. And links to connect with James David and Bill there. Just put them in the chat. Connect with these gentlemen on LinkedIn or email them. You now have their contact info. Please, guys.
All right. Well, thank you very much, Will. Appreciate it. And so this presentation is on overcoming common deal sticking points. Well, I guess I'll just say just a little bit about our firm before we jump in. So we are an M&A boutique. We are a flat fee firm. We operate, it's just James David and I in terms of the attorneys. So when you work with us, you work with us. And yeah, if you are looking at a deal, we're happy to have a conversation. So what we're going to be talking about today is overcoming common deal sticking points. So I want to just kind of set the stage for you. This is mostly focused on once you've gotten under LOI, between signing the LOI and actually closing the deal, there's a lot of stuff that happens. You know, you do financial due diligence, you do legal documentation, all that other stuff. And in that process, there will often be issues that arise that sometimes kill the deal, and there's just no way around it. And sometimes it's a sticking point. So it's something that you can overcome, but you need to be careful and practical about what the approach that you take. So our goal here with this presentation is to help you understand what those sticking points most often are, and what are some tips and tactics that you can use to get yourself a good resolution as opposed to just, killing the deal, although sometimes that's unavoidable. All right.
So first item is kind of diligence findings. And what we most commonly mean by this is that the financials don't come in as strong as were reported. As I often say on calls, financial diligence is the graveyard of SMB acquisitions. So what can happen, right? What often happens is the numbers will come back softer than were reported. So what that means is that the business, right, probably isn't worth what your LOI said, right? Because your LOI is based on having hit certain financial assumptions. Turns out those assumptions were false. And so, okay, well, what do we do now? Right? A few different things to approach this. And here the tip, frankly, the first thing you want to do if you can is figure out what matters most to the seller. Sometimes sellers get stuck on a headline purchase price number and do not care about the terms. Other times, people will only focus on the cash at close. That's the only thing that matters to them. Other times, they don't care as much about the price, but they want the money backloaded or front loaded, right? If you can figure that out, it puts you at an informational advantage, right? To be able to structure your offer accordingly. Then some of the things you can do, right? We can shift amounts of the seller note, right? If the numbers are coming in a little bit softer, maybe we just reduce the cash at close, increase the amount of the seller note. Right? That's one thing. Maybe they've had a big contract that may or may not renew, or a contract that isn't going to renew. Right? Okay. Maybe we make a little bit of the seller note or a lot more of the seller note forgivable in that instance, right? If there's uncertainty around something that you discover. It could be that the working capital numbers that were originally presented were just off. That's a fairly common thing. So that the working capital targets get changed and that effectively adjusts the purchase price. And sometimes the only way to do it is to actually lower the purchase price, right? Because it just doesn't work or the deal won't pencil, right? Because you do have to be able to get investors and or lenders to approve the terms, right? So, and if the deal is going to die over these things, probably better to have these conversations sooner, right? If you know that there's a deal structure change or a retrade, as some people would call it, though a lot of people don't like to use that word. Often better to do it sooner, although sometimes as the buyer, it actually can be better to wait to the last minute, but we'll put that aside. Because these are the sorts of things where if you come in at the 11th hour and drop the purchase price by a couple $100,000, don't be surprised if the seller blows up on you and walks away.
And I think a couple other points I'd like to make. Obviously, if the financial due diligence comes back and the EBITDA is just lower, that's the most common one. But there can be a couple others. So it can be that in the interim period, even though historical financials are great, you see a sudden drop in the business, right? And all of a sudden you're like, well, wait, what's happening here? Right. And maybe there's a believable reason for it. Maybe there isn't. And so that's another area where, forgivableness can be an issue. Or there's either customer concentration risk that you didn't realize, or sometimes channel concentration risk. So it might not be a customer, but it might be like a referral source that makes up a significant percent of the sales of the company. And just I wanted to put that out there just so that you know that there's, in addition to just straight up, there's less money. There can also be other factors that come up in diligence that could, potentially make this an issue.
Guys, could I ask a quick question here?
Yep.
What would you say is the best practice around a premise? No seller, even if the numbers come back light, no seller is going to be like to be told or to be, have it told to them that they need to soften their number, right? No, this is going to be bad news, and the seller's going to get prickly, very likely. So, what is the best practice about language in the LOI for how to kind of preempt that? So, I recall from our LOI webinar, like, you can kind of say there's like a kind of a turn of phrase that you can use that's like, based on this, my offer is this. And so they fully can see around the corner that is like, wow, if our numbers come back light, my buyer, i.e. us, is going to want to see that number come down.
Yeah, we in our LOI template, which you can, if you don't have, you can email us and we'll get it to you, or I guess use the Q&A, we'll get it to you. But we have a sentence. It's like, this purchase price is based on the business having achieved this amount of this metric, equating to this multiple.
Great. Great.
Because that makes it easier, right? It's in terms of how to handle it, right? It's a tough conversation. It's usually better if you can have others at least initially have the conversation with the seller. You kind of want a buffer if you can between buyer and seller here. And that can be attorneys, that can be the broker, that can be whatever. But like you as the buyer need a good relationship with the seller. So you don't want to necessarily be the first person who is breaking this news to the seller. Or you want ideally somebody else to do that.
Great.
And I think there's a couple other points I'd like to add, which is you usually have, a certain amount of cards you get to play with the seller before they get so frustrated that they end up disengaging from the process, right? So doing a change of the purchase price is a really, really big card. And you don't want to, if you've sort of used up your goodwill by trying to, annoy them with ticky-tacky requests or not being responsive or, just not being a good buyer, then when it comes time to this hard conversation, you're less likely to get a positive result. So one of the reasons why you have to be good at navigating your process is because if this does come up as an issue, you want enough goodwill built up so that you can so that you can have this conversation and they're trusting that you're coming from a place of being open and honest and only raising this issue because there is an issue and not just because you're trying to take money from them.
Great point.
Yeah. So
Next issue, that other great deal killer, working capital, which can mean so many different things in these small business acquisitions. And there's myriad opinions on how it should be handled, and there really is no right or wrong answer. But what kills deals most around working capital isn't necessarily the numbers themselves. It's often just a misunderstanding. As in buyer thinks one thing, seller thinks another thing, and those two different things result in a difference of tens or hundreds of thousands of dollars. That's sort of sometimes people fight about numbers too, but it's actually more common, especially in this the smaller we go, that it's just a fundamental misunderstanding. And you can try to educate, and you should try to educate, but you need to understand that your seller is not going to understand all of this until the numbers are actually there, and that's just part of it, right? So this is always going to be tough. So what you want to do, again, maintain goodwill with the seller as much as you can. Blame everybody else. Blame us, blame the accountants, blame the broker, blame everybody else, right? Because you need the goodwill. The other thing is if you can get to a framework, right? Just a true business understanding in kind of plain English or layman's terms or however we want to describe that. We as the attorneys can put that into paper, right? We can put that into the document. We might have to tweak it to be compliant with SBA requirements, things like that. But if you give us a business understanding, we can paper it. So, and it can often be easier to have that, try to put that framework in place before you'll know roughly what the numbers are going to be. But if you can agree on the framework, it makes it easier if the easier conversation when the numbers maybe don't come back exactly what somebody was thinking. And sometimes it's better to break it up, right? So you'll break up accounts receivable, you'll break up inventory separately. Sometimes just mentally that helps people. I don't really understand that, but it's a regular thing.
I think there's also 2 points I want to make, and this, partially deals with working capital and part is a general point. Working capital can be really tricky. And honestly, some of these discussions can be tricky. So I would say one pro tip is to try and get on a call with the seller, because I find that it's good to have an email with a framework, but when you're dealing with kind of complex issues, a lot of times talking through it and making sure that they really understand it is helpful, and you just want to have that. I also find, just as a general matter, that when you have to work through difficult issues, sometimes an email, things can be perceived as being aggressive when that's not really what your tone is implying at all. And so when you have a call, they can hear your voice, they can hear your tone, and it can soften the blow of what you're saying. The other thing I just want to mention here on working capital is oftentimes you'll have deals with work in progress. So this is very common in construction. This can happen often in manufacturing, where they're manufacturing specific parts. This can happen in all sorts of places, but you can have something where they have a bunch of projects that are each lasting a month or two, and you have to decide how you're going to handle that. And this kind of gets wrapped up in the working capital discussion. I will say, in an ideal world, it's probably best for you to buy all of the work in progress and not have to deal with dividing up what you do with the revenues as they come in. In a practical world, a lot of times there's not enough visibility to make that decision beforehand. And if you were to do that, you would have to increase the purchase price and kick it back into underwriting and a bunch of stuff that would slow up the process. But just get ahead of that issue, because that is very commonly a issue where where if you don't have alignment on how these long-term projects should be paid out, that the seller might decide to walk, and that's the last thing you want. You could have that discussion maybe even during the LOI phase. So,
Guys, we're getting that question a lot. Are we talking about doing all of this pre-LOI, this framework setting? First question. Second question, can you give an example of what you mean by framework?
So ideally, you get a framework understanding pre-LOI. That doesn't happen that commonly. You can have a vague cloud, but often you don't crystallize it until you actually just get the financials and see how they've done it historically. What we mean by framework is, okay, how much of the AR, right, is coming part of this? How much, what's the cash conversion cycle, right, impacts this? What are the expenses every month? Like what are the inventory levels normally on a normalized basis, right? Does AR fluctuate? Right? Things like that you want to know. And the framework is just kind of, okay, here's how we're going to handle it, right? We're going to do inventory on we're buying all the inventory. You can say that, right? So that can be part of a framework. With AR, it can be, okay, we're going to do a trailing 12-month analysis. We're going to take the average. That's going to be the target. Something like that. Those sorts of kind of mechanical things are what I mean by a framework, that are sort of independent of the numbers themselves.
Mm-hmm.
But you're not always going to have enough visibility pre-LOI into the financials to get to real detail on some of that. So sometimes you can pre-LOI, oftentimes you can't.
But you do usually have some language in the LOI related to net working capital.
Yeah,
right?
You're going to have something. We tend to be a little bit vaguer than some brokers like. Some brokers want to fix a number at the LOI, which I don't encourage. We usually, our template just says the business will be delivered with a normalized level of net working capital, and we leave it to be decided through financial diligence.
Great. Thank you.
Indemnification, everybody's favorite discussion point. So indemnification is a fancy way of saying that in what instances will the seller owe you money? So a simple example could be somebody sues you 6 months after closing because the trademark that you're using, that the seller used, infringes on the, trademark that was already existing, right? And so you're sued, and so you basically have a claim, and you go to the seller and you say, seller, I'm getting sued because of, basically because you didn't do your IP properly. So you need to pay for that. There are other common indemnification issues. If there's a lawsuit that happens beforehand, there can also be situations where there's losses as a result of the financials being misstated, right? Which can be difficult. So this is really how you get money if the seller has said something that turns out not to be true. Another example I'll just point out is like, they say that they have great relationships with their customers. Turned out they already knew that one of their big customers was going to leave, like stuff like that. So you have a claim against the seller, and you should get money from the seller. But the problem is that, the seller's, frankly, litigating against a seller is difficult. Litigating in general is difficult. And the seller has all the money. So the question is, what is the best way if you have a claim in order to actually get money from that? And in SBA land, when you're dealing with deals that are kind of 5 million and below, it's not as common to have a separate escrow set aside. So instead, you usually have a seller note, and you say, okay, well, if I have a claim, let's say it's $100,000 claim that I have to pay because of something that's pre-closing, then you, the seller, I'm just going to take that seller note and reduce the principal by $100,000. That's the most common approach to take. In larger deals, independent sponsor land, 2 million EBITDA up companies, those tend to actually have a separate escrow account that's set up that goes for like 12 to 24 months after closing. And then, if there are any issues, claims, then you take it out of that escrow. But the problem for smaller deals is that the escrow costs are usually just too high, and nobody really wants to just hold like a couple $100,000 in escrow. So, you end up, that ends up happening, not as much. And so as a tactic, you should include language around a set off in the seller note in the LOI. And I'll just have you know that this is something that very, very commonly comes up in our negotiations as attorneys, because often the seller will say, okay, well, you can set off my seller note, but only if you have a finally determined court order that I owe you that money. And the answer is like, well, if I've already gone through the whole litigation process in order to do that, then I wouldn't set off the seller note. I would just ask you for your money. The set off right isn't actually helpful. The seller then says, well, how do I know that you don't just, make up a claim and say, oh, I have a claim for $500,000, and so I'm just not going to pay you your seller note, right? That's the back and forth, and there are solutions to that, but that's a very common sort of source of tension in discussions.
Bill, this word set off on the seller note, is this the same thing as forgivability in a seller note, or is it a slightly nuanced difference here?
So usually when we talk about forgivability, even though it is, really it's the same thing, but usually when we talk about forgivability, we're talking about the failure of the company to meet some type of financial metric, right? So like revenue declined, and so you get forgiveness if revenue declines. It is also forgiveness, but for a different reason. It's forgiveness in the sense that, I had a claim against me and I had $100,000 in damages. Now I'm just paying you less. I have $100,000 of the note forgiven, but we call that set off when it's related to claims.
Yeah. Great. And just to underline the point that I think attorneys understand intrinsically, maybe everybody does, but it's worth being explicit about. Better to always have the money that's being contested in your possession rather than your counterparties. Say, just put a fine point on that, please.
Yeah, I mean, right, the quip, possession is 9/10 of the law, right? But it sets, whoever has the money sets the default, right? If you have the money, then well, you don't have to go after the money. The seller has to come after you. If the seller has the money, then you have to go after the seller, and that takes time.
Yeah.
And
And
so by having a set off, you're kind of inverting it, right? So usually the defendant has the money, you have to go after them. By effectively denying payment of the money, now the money is in your pocket and the seller has to come after you, which is a better
I mean,
position.
set off is not perfect. It does not solve short-term liquidity issues necessarily, but it is the most common approach in SBA deals.
And it's just such a good lesson in kind of all transactions. Better to be the one with the money and not have to pay it than to have to go out and claw back money that you have paid.
Yeah.
Exactly.
Okay, thank you.
Okay, next issue that actually killed a deal a couple weeks ago. Landlord consents. So if a landlord, often in these transactions, in SBA transactions, you're entering into a new lease. Sometimes in a sponsor transaction, you would do a new lease. Sometimes you would assume a lease. But even if you are assuming the lease, it's normally going to require landlord consent, landlord approval. We've had deals get to the very end and die because the landlord wouldn't sign a new lease. We've had deals die at the very beginning because of this issue. It's better if it's going to happen at the beginning. Some businesses, this is less of an issue, right? If you're buying, if it were a professional services business, for example, right? It doesn't have to be in a particular location. There's no heavy equipment sitting on a factory floor. Then this is probably less of an issue and you can, choose a new office space. But if it matters, it matters. And the tip is just to address it early, right? If it's going to be an issue, let's find out now, right? Before you incur a bunch of costs. Because if you are just running into a brick wall with a landlord, right, better to know at the outset. One thing people ask is it better for you as the buyer or is it better for the seller to have the conversation with the landlord? It is almost always better for the seller to have the conversation with the landlord because the seller already has a relationship with the landlord. That is not, there are no absolutes, but that is almost always the case. And if you do have a business that, and sometimes the seller's broker can be your friend in this way because the broker, right, this is one of those obstacles to the broker getting their commission, and so they can help you out sometimes. Not always. Sometimes the brokers will actually know the landlords too, right? We've had that happen also. But if the business is one that could be in any kind of generic office, right? It's worth exploring alternatives as part of your process too, just in case something stupid happens. Because it would be unfortunate. It's unfortunate when this kills a transaction, but it can.
Non-compete provisions. So this is commonly a topic that comes up and can be quite a negotiation. So you generally want to have as long and as broad of the non-compete as possible, and the seller wants to have as narrow and as short as a non-compete as possible. Usually where you land is to have a non-compete that is long and is a large geographic restriction, but is narrower in terms of its focus, right? So your goal is to basically say, hey, look, this is actually what I need. I just need you not to compete in this specific thing, but it needs to be for a very long time, right? Because a 2-year non-compete, you could just sit out take your money for a couple of years and then start up the entire competing business, 24 months from now. You don't want that. You want the kind of full 5-year non-compete. Usually what we do in this case is we just kind of make the maximum proposal and then see what the seller comes back with. A lot of times, frankly, the seller will accept it. Sometimes if they're retiring, they just don't care. It's also very common for them to say like, hey, like I have this personal project, or I want to like do work with friends, or I want to like help those friends out. And then you kind of say, okay, well, kind of put in your exceptions and we'll take a look at that. And usually that works out well. Something to keep in mind is that there's a lot of discussions about non-competes and how they may or may not be enforceable in basically everywhere in the nation. If you're actually selling your business, then you are able to enforce a non-compete against them. It doesn't necessarily mean that there's no differences between states, but you can have non-competes in these situations. So even if you can't have non-competes with employees. But this also raises an important issue, which is another issue which comes up with non-competes actually relates not to the owner, where it's actually pretty easy to bind the owner pretty aggressively, but with the employees. So if you're coming in and there's a key employee, like a sales rep or some type of other operator or whatever it is, you might be afraid that you buy the business and then 6 months later they jump ship, that key employee, and starts their own sort of competing business. The truth is that is a difficult thing to deal with. Where we usually see this coming out is usually you focus with employees not so much on non-compete, but non-solicitation. Non-solicitation means, hey, if you leave, you can't talk to any of our customers, you can't hire any of employees, you can't, basically use any of the contacts you developed to start that other business. It's nice to get a non-compete as well, but two things. One, they're not always as enforceable with employees, depending on the geography. And number two, sometimes that'll scare the employees. We've had situations where we've put together an employment agreement that included non-compete provisions, and we talked to the seller before we presented it to the employees, and the seller was like, look, if you put this in front of my employees, this is really going to start off on the wrong foot. Like, they've been around this company for a long time, and they don't want to like not be able to work after we're done here. And so you probably want to work with the seller on terms of how you want to communicate any sort of non-compete, non-solicit issues with the employees.
Okay, last slide. So some issues around the seller note. We've already talked about set off and indemnification claims. So this is a separate discussion around the seller, which often it's not a seller, often it's the broker, sometimes it's the lawyer, but whatever. We'll say seller wanting you as the buyer to personally guarantee the seller note, or to take a second position lien on the assets of the business or the equity of the business as collateral for the seller note. So sometimes people, and this is one of those things where some sellers it doesn't matter at all, and then there are other sellers where this is the hill they choose to die on. So just know that. A lot of times people in the SBA context are pretty don't quite understand the difference. They say, well, I'm already PGing the SBA loan. What's the big deal about PGing the seller note too? And the answer to that is potentially the seller is much more likely to foreclose on the note or put you into bankruptcy than the bank is. The lender does not want to foreclose on that note, right? The lender doesn't know how to run whatever business you bought. They want you to run that business. They want you to make the payments. That's all they want. So they're not likely to foreclose. They're much more likely to work with you. Sellers, right, they want their money. And so that makes them more likely to foreclose, which can have pretty drastic consequences. So that's why it is a personal guarantee is something don't want. Sometimes it becomes necessary, but we don't want them. If we do have security interests, right, the bank is going to have a first priority lien on all of the assets of the business, right? That's just kind of universal. If there's also a secondary lien on the business, on the assets of the business, then it's going to be almost impossible for you to get additional financing without clearing the liens. Maybe you could get somebody to take a second position, right, an additional creditor, but you're not getting somebody to take a third position on a small business. So if they do securitize the assets, then right, you are a little bit more limited in your financing options, which frankly are pretty limited in the first couple of years anyway, after one of these acquisitions. But if you do have to give a security interest in the seller note, it's better to do it for the equity of your company, of your operating company than the assets of the business themselves. That is maybe a little bit too technical of a point, really, but it can make a difference.
And oftentimes where it really makes a difference is after 2 years, you can potentially refinance into a new loan. And if you have a seller note that's secured by the assets, you might not have that option. And that could be the difference of like 2% interest a year, like this is not nothing to have the option. And you often don't want to refinance and also pay out the full seller note, because that would be what you would have to do. So
that wraps things up for us. There's already things in the Q&A. I'm sure we'll do a little spiel to get that populated, but thank you for attending. As Bill said at the start, we're Barlow and Williams. We are a two-person M&A law firm working with buyers and sellers of businesses anywhere. We do a lot of self-funded search. We do some independent sponsor transactions too. And we represent sellers, so we get to see all sides of this wild world that is S&P acquisitions.
exactly.
Thank you, guys. Wonderful presentation, as always. So rich. I just want to highlight what you guys were just talking about on that last slide. Could you go back to the seller note slide? Which is, and I'm actually just going to repeat something that you guys said in our previous, either a time or two ago, that really crystallized something for me, which is buyers will often think that the bank is the scary lender. If you got your bank and your seller, and you're now indebted to both, and you just there's an intuition that the bank is the big scary lender and the seller less so. You guys made the point that you just made it now, but you made it even stronger last time that banks are likely to react more rationally to a situation if you find yourself in distress. As you guys said, they're going to want to work from you. They really don't want to take over your business. They just want to get you in a place where you can keep servicing the loan. And they have a portfolio of these loans that they're looking at. So they're going to act much more, I think rationally would be the word. Your seller is a single human. This is probably the only such transaction they've ever done in their lives. If they're retiring, it's the last time it's their last payday of their life, literally. And they're a human, and they're a single human, so they're less likely to be rational and maybe very irrational or emotional. And as you just put it, James David, they want their money. So if you have a personal guarantee with both of these parties, it's actually your seller that you got to worry about. It's going to really come after you and press you on that personal guarantee. I just thought that was such a great point, because I think it's counterintuitive. But once you hear it spelled out, it's like, oh yeah, good, yeah. Sellers are the wild cards here.
Yes.
Great. Okay. So from the audience, let's see here. Back to non-competes. How do you think about non-competes if there are family members in the business?
That's where it gets really hard. Is what happens when the son or daughter is an employee. Those are the hardest situations. And there's not a uniform answer, right? Some things do depend on what state you're in as to what your options are. California would be one of the more limiting states, for example. What could happen in some places is that if it is that family member situation, you could even say, seller, give your child a little bit of equity before the transaction and make them an owner. Because then if they become an owner, caveat, a few states, it does have to be meaningful ownership. But if they're an owner, then they can be, right, then they can have the same restrictions as the seller, right, because they're selling a business. But if they're purely just an employee, then we gotta navigate it, and you have to really think hard about what happens, right, if that person does leave, because their parents just got a whole lot of money from you and might be willing to fund a startup venture.
Something else we saw on a recent deal, which they were buying from an owner and there were two sons in the business. This wasn't an SBA deal, which made it easier, but they had the two sons actually buy in. And as part of that, they had a shareholder agreement or an operating agreement, depending on your entity. And they agreed in that shareholder agreement to not compete, right? So if you bring them into the fold and make them an equity owner, that can also increase your ability to have some more enforceable non-competes. Understand a lot of times you don't want to do that for other reasons. It does complicate things, but that's another thing that we've seen happen.
And that was giving them equity after the acquisition.
Yeah.
For clarity. So
Yeah.
making them a part owner after
Yeah.
the acquisition.
And they actually put money in as part of the equity check in that particular transaction. Yeah.
Great. How do you quantify the appropriate amount for the set off in the indemnification slide there? Or do you just say that any claim, or do you not have to specify? Do you just say that any claim would reduce the amount paid of the seller note by whatever the claim is?
I mean, there could be a limit to the set off. There will almost certainly be a limit to the indemnification claims, right? Something called an indemnity cap, right? There will almost certainly be that. The norm would be that set off it's either you can or you can't. There's not commonly a limit on the amount you could set off if it's available, but in theory you could. There could be a limit, but it's likelier that the limit would just be the cap on indemnification.
What about reps and warranty insurance in lieu of indemnification escrow?
Yeah, not gonna be reps and warranty insurance at this point. I think the kind of common floor is about $30 million transaction. There are some newer rep and warranty insurance products that are targeting smaller transactions, but they're still so new that they don't have the claims history behind them to be widely accepted. So rep and warranty insurance not common at this size of transaction we're talking about.
And keep in mind that the lower part of the market is very messy. And so it's very difficult for insurers to underwrite that risk. So what they often will end up doing is add a lot of additional exclusions to what is covered under the policy, right? And so unfortunately, that means that those exclusions limit how much recourse you actually have in case there's a breach. So,
Because there are no audited financials in these markets, or very
yeah.
few. And so because of
They're
that,
not gonna stand by any financials that aren't audited. That's probably one of the biggest ones.
Is the set off in the seller note, is that something that you do at the LOI stage in the LOI, or is that it for the purchase agreement?
We might have a line about in the LOI. I think we
we do have a line because I put it there. So it is in our LOI template, but it will go in the purchase agreement, but it will also go in the note document itself.
Yeah. And the funny thing is, even with that language, which we do include, there still usually ends up being a fight about, well, what exactly, at what level does the claim have to be in order to, include the set off? And, it's, we find it's too detailed to go into that level of depth at the LOI. So you end up still, even if you have it in the LOI, you still end up having fights about it.
Going back to that point about if you go to the last slide again, Bill, yes, here, the security interests. So somebody just wanted you to elaborate on why you said it's better that the interest be in the equity of the business rather than in the assets.
This is a marginal difference. It's not a huge deal, but it's marginally better if it's on the assets, because it'll allow you potentially to refinance your SBA loan quicker.
It's better if the interests are secured by the equity and not the assets.
Right. Because if they're secured by the assets, then in order to do a refi, you would have to clear, or you have to clear the liens to do a refi. So if the seller's lien is on your equity instead of the assets, then it doesn't have to be cleared as part of that refi process.
I see. Any tips on how to structure agreements with the seller staying on to work for you in the business? It's kind of a very big open-ended question.
Well, in SBA land, that's going to be very limited because they can only be an independent contractor and they can only do for 12 months, right? Unless they're rolling equity, in which case they have a personal guarantee and those are less likely with the new rule changes. If you are not doing an SBA deal or they are agreeing to roll it, then what you can do, you can be much more creative in how you do that. And there's lots of different options to incentivize them. And it really depends on what you envision their role being. Like in private equity buyouts, oftentimes, frankly, they end up like basically having the person that just had the buyout continue to run the business full time for the next 5 years until they get their exit, right? Those are real golden handcuffs. You may or may not want that, but that's on the higher levels of the market, that's more common.
And I'll just, as a general note, incentivize what you want from the seller. Make the incentives align, right? If you want the seller to help with sales or help roll over some particular customers or whatever, right? Incentivize that. It may go in a forgivable portion of a seller note. It may go in a consulting agreement, maybe an employment agreement, right? Depends on the context, but think about what you want from them and pay them for that.
Yeah, it's good.
And the other things we'll say is the simpler the metric, the better. People can get really complicated. We like revenue because it's easy. EBITDA is more complicated. We see it happen, but you often get into fights. And if you really start getting into left field and you start creating these like real complicated things, I usually don't understand them. And if I, as somebody who works in this industry, for doesn't understand them, then the seller certainly doesn't understand them. And if you don't understand something, you're not likely to be incentivized very much by it. So, you know, as, keep it simple, stupid, as the more simple you can get it, the more elegant and usually the better it's going to be.
We talked about retrading, where your first sticking point was diligence coming back light, or numbers coming back light after the financial due diligence. How do you see the happy case, or seemingly happy case, where the business is doing better over that, the numbers come back better than expected?
That's much rarer, to the point of being often irrelevant, unless they've just gotten like a huge order. There's some businesses, right? They get a huge order while you're under LOI. And if it does come in a little bit higher, then that's sort of water under the bridge. It's not common for there to be a retrade up if it was 5% higher or something. Because frankly, the numbers don't come in higher. Right? But what can happen is if there is a big spike for some reason, that can lead to a seller saying, I don't want to sell right now. Right? That's fairly common if there's a big spike, or there's a big spike in. But we talked to somebody this week where there was a big spike in the first half of this year, and because of that, SBA underwriting is going to probably not work. Right, so there can be complications of that, right? If there is that big spike, but if it happens, it's kind of up to the seller to decide. Right? Sometimes they walk and say, "No, we'll just wait 6 months and we'll sell it for more." Sometimes they say, "I'm done. Let's just get it over with."
And often if it's the second one, right? And this often happens, at least in my experience, this often happens less that the financials get recast upwards and more that like the company has continued to really perform well during the interim period, right? You oftentimes how that manifests is you end up just having less leverage as the buyer and you end up giving on more points because you know that like business is going well. So like points that you would have fought more over, you end up like being less aggressive on your net working capital target and less aggressive on some of the other points we talked about. And basically we often get the message, hey, like latest financials came in, these guys are doing really well. Buyer's attorney, like let's just get this deal done as soon as possible. And if we have to give on some points, let's give on those points. And that can happen too.
Yeah, that's great points. I would just say, from what I've seen, that I think the answer is like, wait to see what the seller does. You don't have to volunteer coming up in price. So just stay cool, stay silent. And if the seller wants more money, believe me, they'll let you know. And then you're back in a negotiation.
Yeah.
But you don't have to say anything and see what happens. The ball's really in their court at that point.
Yeah.
Sequencing this stuff, common question here. Do you guys typically recommend that buyers engage with legal counsel prior to an LOI? That seems premature to me in terms of the, staggering how money is spent over the course of deal costs. But I'd like to hear your opinion, says the.
It is our preference to be involved in finalizing the LOI. That may not mean the initial draft, although we do work with people when they're on their first one. But a lot of people, I think dozens of people at this point, have used our template kind of in a DIY circumstance, and then they come to us when they receive feedback from a seller. We do like to be involved in finalizing the LOI, and I think you should have an attorney, whether it's us or someone else, review an LOI before it gets executed, because anything that's in that LOI is anchored, right? There's a psychological anchor, right? I know the document says, it's mostly non-binding, but there's the reality of, right, anything in there, right, the seller's going to anchor to.
Yeah.
And you need to understand, especially if you've gotten a bunch of red lines back on the LOI, you need to understand what those red lines mean. Because we've seen people come to us and they've agreed to things, and then we explain to them what those things mean, and they realize that that's not what they thought they signed up for. And so it's like, oh, okay, so we have an LOI that's worthless. That's fun. Let's see if we can get to a real LOI and then move forward. In terms of deal costs, right? That's part of that dynamic, and we understand the deal flow and all of that. That's why we sort of structure our fees the way we do and backload things. Right. So the initial bit, we do flat fees, but we do milestone-based payments that are backloaded to account for exactly this sort of dynamic.
And another thing I'll say is that I truly understand not wanting to engage an attorney every time you send out an LOI. It is cost prohibitive to do that in our experience, right? So, what you want to do is you want to get fairly comfortable with the templates and other things that you're sending out. You can reach out and ask questions, but you want most of that work in terms of sending the LOI, you want to be able to do that without an attorney and racking up costs. But then once you're really one of the either you're selected as the winner, or there starts to become back and forth, it's that's often the best time to reach out. And honestly, we've been flexible. We understand if you bring us in and then the LOI falls through, like, we roll fees, we do other things like that. So we understand where you're coming from, but we at least tend to be pretty accommodative to that situation.
Can you guys expand on your milestone based and backloading of the fees?
Yeah, so it does vary based on the structure of the deal and things like, do we have equity investors involved, seller role, whatever. But there are going to be between 2 and 4 milestones in a transaction. 2 tends to be on the sell side, although that can be 3, and then buy side can be as many as 4. But where those sort of are is kind of start of engagement, drafting transaction documents, which there can be multiples, internal, external of those, and then the last milestone will always be closing, and then we just allocate the fee percentage wise among those points, whether there's 2, 3, or 4 in the particular transaction. And all of this at the start. Right? This is in the engagement letter, laid out in a nice, pretty table that our assistant helps prepare. And so it's what your legal costs are for the transaction before you start. We will almost always roll that first milestone, whatever it is, just because of the way deals work. Beyond that, it becomes a conversation. We don't have kind of hard and fast rules, but that's a rough outline of how that structure works.
And by roll, you mean what exactly?
Yeah. So if you engage us on the buy side, we help you finalize an LOI. All right, you get under LOI. You do the QOE, and the numbers are just too soft. Right. So we've got these things on the screen about, but the gap's just too big. Right. We got to kill the deal. Right. Okay. So but you've already paid us that first installment. So what roll means is that when you cut in the next deal, we credit that amount.
Great. And that, of course, point being that saves the buyer on broken deal costs, which can be so high.
Yeah.
Great. Thank you, guys. Going back to keeping a seller on, or forgivability in seller notes, kind of performance-based metrics. Two people, one asking the same thing, is gross profit a decent metric? Bill, recall you said, you like just straight revenue. Is gross profit a decent one? Ask somebody. Or what about gross margin? Or is that too complicated? Your thoughts on those two options as metrics to track against?
I mean, we've seen gross profit be used, and it depends on the industry, right? I mean, like if this is something where you are, manufacturing, it's a little bit easier to do that, right? Because it's a little bit more straightforward. When you talk about gross profit and more services, it can be a little bit more complicated, right? Like, are you tracking the hours of all the employees that are providing the services? How do you calculate that? All of those things. And, you want to make sure that whatever metric you sign up for, that you easily have a way of getting reporting on that metric, because if it's difficult to calculate gross profit, given how you plan to run the business and do profitability, then you're running into that wall. If it's easy because they already do that and it's already set up, then that's a lot easier to have. Usually we don't see gross margin necessarily. Gross margin is a little bit difficult because you as the buyer have a lot more room to play with that if you want to, provide discounts and other stuff like that. But gross profit is something we have seen.
Okay. Great, guys. Let's call it there. We got to most questions today, James David. So hopefully for your vacation that you won't have a bunch of unanswered questions waiting for you when you get back. There might be a few, but we got most of them today, which is great. Thank you guys, as always, for just fantastic presentation and for answering all these questions. Thank you, audience, for your attention, for coming. Connect with James, David, and Bill. I just put their contact information again in the chat, so you can connect with them on LinkedIn, and then both of their email addresses are there, and their website is there. And we've been recording, so everybody who registered, so all of you listening right now, will receive an email with a link to the recording and to the deck itself. And yeah, a couple of people are asking you, James David, for the LOI template that you said, if you just give me your email address. So folks, if you ask for that, and somebody here anonymously asked for it, you're probably going to have to reach out to James David directly. You got his email address right there. That's probably the safest way to get your hands on that, but he'll respond quickly with it. And with that, everyone, watch for James David and Bill's next webinar next month. We'll be publishing that in the week or so ahead. Keep your eyes peeled. And this ends the webinar. Thank you, everyone, for coming. Bye.